So we're here for the profitability track. That's what it says on the schedule. And basically what this is that FXCM has access to all of our client data, obviously. And what we have is basically stats on whether or not our traders are profitable, when they're profitable, why they're profitable, how profitable are they. And really, I've spent months poring over this data and tried to draw conclusions. And on the face of it, the truth isn't very pretty. But at the same time, if we can find out what common mistakes we can avoid, we can go a long way to making this a profitable enterprise. And I want to emphasize that that's what we're after here. You're not here just for the sake of gambling. That's what the blackjack and roulette tables are for. If you're in Forex, if you're a trader, if you're putting the time and effort, you want to make money. So when you begin to understand why some traders might make money and why others won't, that's a huge part of the game, and really understanding how to increase your chances of success. Now, obviously, we're talking about profitability, but I do have to emphasize that Forex can be very risky, especially when you're trading with leverage, and in the US, it's 50-to-1 maximum. You can lose a lot of money. Obviously, it's a double-edged sword. You can make a lot of money, but at the same time, you don't want to get into this, and you especially don't want to trade with leverage with anything but risk capital. So, contact your financial advisor. Do not use your pension checks to bet, 50-to-1 on euro dollar, because you could lose it quite quickly. Also, I'll be talking a lot about hypothetical performance. I'm kind of a gearhead. I'm a quant. I talk about back tests and what have you, and testing systems. One thing to keep in mind is that I did the best to my ability to make it a clean study or to make it something that has a great chance of being repeated. But hypothetical back tests have the unique advantage of the benefit of hindsight you won't have with trading. So just because something worked in the past, it's no guarantee of the future. So the title of this presentation is very simple. What's the single most common mistake traders make? And to really understand that, we really want to understand the common profile. So what we did, like I mentioned in the intro, is basically look at our entire sample of data and say, okay, well, how profitable were our clients across this span of time? So let me explain this chart right here. This chart basically shows you the 13 of the most popular currency pairs on FXCM's platform. And what those bars are showing, this is measured across 4 quarters. What those bars are showing is the percentage of traders who traded, let's say, the Australian dollar, Japanese yen, or traded the euro, US dollar, and were profitable through that span of time. Now, what I'll point out is that dotted line in red right there, and that's the 50% mark. And what's immediately striking is that the vast majority of those bars are below the 50% mark. That is to say that the majority of traders are not making money on these currency pairs in these 4 quarters, with the exception of the Australian dollar, New Zealand dollar pair, in the 3rd quarter of 2010. And obviously, this is only a year's worth of data, but I've seen other blocks of data, and it's remarkably consistent. So it gives us a really good sense of the general characteristics of what this looks like. Now, the really interesting part, and what really draws my interest in this, is something that might come as a surprise given the earlier slide. And what's surprising is that this chart, let me explain it, the same 13 currency pairs, it shows us as a percentage of all trades how many of those were closed out at a profit. Now, I didn't draw the dotted red line, but you can see that with exception of the Australian dollar Japanese yen pair, all of those are above 50%. That is to say that the average trader, the average FXCM client, is closing out most of their trades at a profit. Now, how do we reconcile that with the fact that they're losing money overall? Well, I don't want to spoil the surprise, but that's what this presentation is about. And in fact, we look at the actual profile of those trades, and we understand a lot of why that might be the case. Risk-reward profile tells the story. So, similar chart, same 13 currency pairs. Instead of a percentage, I show you the average profit made in the bar in blue on each of those winning trades, and the average loss in the bar in red. And what will immediately strike you is the fact that those red bars are significantly larger than the blue bars. So, taking the most popular example, by far the most popular currency pair we trade, the Euro-US dollar, you see that if you go back to the chart, you see that clients make money on approximately 58% of all Euro-US dollar trades. Unfortunately, that average winner is only worth 65 pips through this year in the sample. The average loser is 127 pips. So even if you're making money most of the time, if you're losing almost twice of what you're making on the winners, you just don't stand a chance of winning, and it's just pure numbers. Now you'll notice that the reward to risk profile is a little bit more favorable for other currency pairs. You know, the average is better than the Euro-US dollar itself, but at the same time, you're just seeing this across the board. You're seeing that the average loser is much, much bigger than the average winner, and that's a big problem. So zooming in a little bit, again, 58% of all Euro-US dollar trades were closed out at a profit. Unfortunately, each of those profits was only worth 65 pips. Each of those losses was almost twice that at 127 pips. So we're going to talk money management. We're going to talk what it means to actually manage your gains and your losses so that you actually have a winning chance. You know, if you're trading like this, and again, if you're the majority of the time you're right, that's great, it feels good. But if you're letting your losses run amok and you're taking your profits way short, you stand virtually no chance. So what is money management? Money management, you know, as it sounds, it's how you manage your money. So at the end of the day, again, that first slide, or the second slide I should say, was really striking. The fact that traders are right most of the time, and yet they're on average unprofitable over large stretches of time. What is money management? You know, cut losses early. It sounds simple. You know, it really does sound simple, but I think it's fundamentally human nature. We don't want to be wrong, and we've all been there. You know, the trade's going to come back. Okay, it went through my stop, but I moved my stop a little bit because I think this is a better stop level. And you know, you can make that work. I'm not saying you can't. There are no absolutes in trading. But at the same time, if over time you're letting those profits cut short, letting those losses run, you're just not going to make money. Especially if you're only making money on 58% of trades, and I put only in quotation marks because that's a pretty good winning percentage. I mean, we've all been there. You know, you have a small loss, and you say, I'm going to let it run because it's going to come back. But, you know, that small loss turns into a much bigger loss. And at the end of the day, you're like this gentleman here, just, you know, down on his luck, just looks, you know, miserable because he knows that if he had cut his losses early, he would have been in much better shape now. And that's really what I want to get at. If nothing else, you need to understand, if you take nothing else from my presentation, just understand what it means to cut those losses early and admit that you're wrong. And I know it's difficult, but admit that you're wrong and give yourself a better chance of success. On the flip side of the coin, again, if you're making money on 58% of trades, you do stand a pretty good chance if you're managing your risk properly. But at the same time, you know, you have to let those profits run, especially as compared to the stop losses. And what that means is just allow yourself to be successful. If you just got burnt worth 127 pips on a euro trade and you're floating a 65 pip gain, you know, it does feel good to just hit close on that trade. I think it was JP Morgan that once said, you know, you can't go broke taking a profit, but you know, if your average loss is twice that of your profit, you're definitely not going to make money anyway. So you're not going to go broke on taking that winning trade, but at the end of the day, what matters is not that one trade, but your track record over time. And again, if those losses are much bigger than your gains, you're just not going to stand a chance at winning. So it's one thing that bothers me about reading about trading and just trying to learn trading is that everything is very abstract. I obviously was just very guilty of that. You know, cut your losses short, let your profits run. I don't know what that means in concrete terms. So as a bit of a gearhead, as a coder, what I really like doing is just playing around with price action, historical price action, and I want to emphasize that past performance is no guarantee of future results. But at the same time, if you look at what worked in the past, you have a better chance of success in the future, in my opinion. So who here knows the relative strength index? Raise your hand. So the majority of the crowd knows what the relative strength index, the RSI, is. And I did that on purpose. Well, I'm going to be talking about the RSI strategy a lot today, and a major reason for that is that it's really popular. Another major reason is that it actually fits the profile of how our clients trade very closely. I mean, it's remarkable, really. So I want to take the RSI strategy as a general proxy for our clients and try to fit, actual money management rules so you can get a better sense of how you can increase your chance of success. I'm not going to say you're going to walk out of here a winning trader, but at the same time, you're going to understand, fundamentally when this strategy works, when it doesn't work, how to make it work better as a good proxy for the average client. So the RSI strategy is very simple. The RSI is an oscillator that goes from overbought to oversold. If that line all the way there at the bottom is the RSI indicator. And what it's showing you is where we stand relative to whether we're overbought or oversold. If it's very high, we're overbought. Very low, we're oversold. So the most common overbought, oversold levels, I won't go into the specifics of calculating the index. I mean, you can literally find it on any charting platform out there. But basically, traders consider that a currency is oversold if the RSI crosses below 30, it's overbought. If it crosses above 70. So what we're going to do is we're going to buy when that 14 period RSI, and the 14 period is the standard, crosses above 30. Now, notice I didn't say buy when it touches 30, because sometimes you're buying into the worst of the declines. You give yourself a better chance, in my experience, if you buy the dip, so to speak, in this strategy. So we're going to do exactly that. When it crosses below 30, we're going to buy it when it crosses back above. And the opposite. When it crosses above 70 and crosses back below, we'll try to sell strength and see if that works. So in this particular example, I obviously cherry-picked it to pick something that worked reasonably well. But notice that the RSI strategy works pretty well when the currency isn't going much of anywhere. So if it's just in a choppy range, it's going to do great because it's selling something that's expensive, buying something that's cheap. And again, I want to pull this back to what we naturally do. I naturally look at something and I say, that's too expensive, I want to sell it. I naturally look at something and I say, that's fallen too much, it's way too cheap, I want to buy it. And that can work. That actually works probably more often than not, according to our stats. But what you really need to understand is that there are times that doesn't work. And managing your risk in those times can make the difference between losing all your money and actually making money in Forex trading. So I'm saying it ad nauseum. It just resembles the average client really closely. Over the course of approximately 8 years, we had 481 trades on a 60-minute Euro-US dollar chart from 2002 to 2010. The number of winners was nearly 300 at 297, losers 183, for a percentage profitable of nearly 62%, which is fantastic and remarkably similar to the 58% that we actually measured within a specific time frame of those 8 years. And again, the average winner, respectable, 94, this is Euro-US dollar, so those are 94 pips. The average loser, however, is almost twice that at 175 pips. The net result, the average trade is actually a loser, even though we're making money 62% of the time, which is just unfortunate because if you're right most of the time, if you can pick direction closely, I think that you should actually be making money. But again, if you're just letting that loss run while taking that profit early, it's just not going to work. I bring it right back, and I think it's just really interesting that it's just so remarkably close to what our clients actually do. And I don't have the chart here, but I've run correlation studies of client trading performance against what the RSI strategy is doing, and it's really close. I think part of that, again, is the fact that the RSI is very popular. Another part of that is the fact that I think it's just human nature to buy something that's oversold, sell something that's overbought. And again, we go back to the same risk-reward profile. The numbers don't line up exactly, but the general theme is there. Losses are almost twice that of the average gain. So, truth be told, past performance is no guarantee of future results. So you do need to control risk, even if I show you a really pretty equity curve, and trust me, there will be some pretty equity curves today. You do need to understand that systems don't always work. So here we have the performance of the RSI strategy on a 60-minute chart on these three currency pairs against the euro, US dollar, the US dollar Swiss franc pair, and the sterling dollar. And what you'll notice is that the euro is just pretty terrible overall. The RSI strategy has not really made money, basically since the onset of the financial crisis in about 2008. But what I will point out is the fact that there are pretty good winning stretches there. I mean, it's not a totally lost case. If we can figure out how to make it work and work consistently, we can take advantage of those good winning streaks. I mean, I'll point out the US dollar Swiss franc, and I think if it's difficult to understand what past performance is no guarantee of future results really means, I mean, take a look at that Swiss franc equity curve, especially in 2009. I mean, that's just crazy. It's just virtually a vertical line. What happens next, and the Swiss franc equity curve, if you can't see it properly, is that line in orange, the one highest on the chart. It just did fantastically well through 2009, and since then, it's just been awful. And if you look at a Swiss franc chart, you know why, because it's basically marched through parity and it's been an incredible downtrend. And the sterling is a great example of that too, because it's been awful since 2008, but 2011 has been great. So we're seeing some characteristics of the RSI strategy that can help us understand how it might work better. And I think, again, this has a lot of parallels with actual client hard data. The numbers don't really lie. So when you see that strong correlation, that strong link, the statistician in me will say correlation is not causality. It's not an absolute link. It's remarkably similar. It's kind of tough to say that's coincidence. So when we see that traders are really streaky, we want to use that information to try to improve profitability and your chance of success. If you know that when you are good, you're really good, and you're good for a long time, use that to your advantage. But when you're wrong, you're going to lose a lot. Also use that to your advantage. So we'll go back to the RSI strategy. I just showed you the equity curves across those three very popular currency pairs. And again, the rules are simple enough. Buy when the 14-period RSI crosses above 30. Sell when it crosses back below. And that works really well when markets aren't doing anything. When the euro is just bouncing around, support resistance, you can see in those hypothetical trades how well this strategy could have done. I mean, it practically picks tops to the pip. Problem is, you go a little bit later, all of a sudden, not so good. When markets actually break out, when, again, this strategy can be really streaky, and it tends to be very streaky. When it's going well, it goes really well. When it goes bad, it goes really bad. And you can see that on the chart. Just because you picked up, let's say, a few hundred pips in that wide range there, all of a sudden when the euro crashes lower, you don't stand a chance. I mean, if you didn't have a stop loss level there, you would have easily erased all the profits you had made just previously. And as a sneak preview, we're going to talk a little bit about identifying market conditions in a subsequent seminar, but this one's more about money management. Stick with me today, and we'll talk about trying to identify the proper market conditions for range trading strategies, and actually breakout strategies too. So what do? We're going to put a stop loss, and this whole presentation is about money management. We're going to set a maximum loss on each of our trades. We're going to set a profit target on each of our trades. Because again, we know that if we're right, we're pretty right. It just bounces around. We're picking up a good number of pips. Again, the average winner for this strategy was about 90 pips, give or take. Average loser, more than twice that. So we know that when we're right, we're right by a decent amount, and you know it pretty quickly. You see those trades there. If the RSI is in the proper environment, it'll probably pick the top pretty close. So you don't want to get too greedy, though, because at the same time, if you are in that range, it's not going to make a blockbuster trade. So I'm probably going to place a pretty close profit target. The stop loss, on the other hand, when you're wrong, you're really wrong. So you want to protect against that as best you can. And really, the only way to protect against that consistently, in my opinion, is to limit your max losses. What does that look like? I mean, it's pretty simple. I apologize, it's a little bit difficult to see the text. But basically, we're just going to put a profit target. If we make 100-something pips, we're going to close out our trade. If we lose, similar, we're going to close out our trade. And basically, you can see, again, just generally, This works pretty well in range-bound environments because when the RSI strategy does well, it does well by a fair margin. When it does poorly by a much bigger margin. So same disclaimer on equity curves applies here, but we have two of them. And this is the US dollar Swiss franc pair RSI strategy going back approximately 6 years. And we have two lines there. One is the line in blue, which is the base RSI strategy that, again, had a phenomenal 2009 and since then has just been frankly terrible. And we have the orange line, which is the optimize. I added a stop loss here. I added a profit target here. And as it turns out, the best profit target that we could have added, and I programmed this into actually our own FXCM strategy trader platform, and I basically tell it, give me the best possible combination of a profit target and stop loss. Over the course of these 6 years, that actually turned out to be 120 pips profit target and 115 pips stop loss. And that line in orange is the hypothetical equity curve of how that strategy would have done. Now, to tell you a little bit more about this system, again, 6 years of performance. We're starting at $0, but each of those trades is a standard 10K lot. So that gives you a sense of how much money you could have theoretically have made if you had traded this strategy. So what I want to draw your attention to is the fact that the lines look remarkably similar. It's not a dramatic improvement. But if you take away 2009, which again I think is a bit of an aberration, because again 2009, just to give you a general sense, was when the global financial crisis was receding. So we're seeing big currency moves, which is great if you're looking for big profits, but we were just moving around in big ranges. So it was just like ideal conditions that I don't think will be repeated anytime soon. If we take that out, that orange line is way better than the blue line. And again, it just comes down to that profit target. When you're right about 120 pips according to this optimization study going back 6 years. When you're wrong, you want to limit how much you're wrong to 115 pips, and that improves your risk-adjusted returns pretty well, with the exception of, really what were the best conditions for this strategy in a very long time. What I want to emphasize here, too, is that you don't know where on this equity curve you're going to start. So, I'm showing you the past 6 years. 6 years is a lot of time, and over those 6 years, this strategy has done pretty well. But imagine if you had started with this strategy at the end of 2009, beginning of 2010, when the dollar Swiss franc began a massive downtrend. You could have lost your shirt. So again, you're looking for the risk-adjusted return. You're looking for how much you're really risking versus how much you stand to gain, because you don't know how well that strategy is going to do. I mean, there are ways you can improve that equity curve, and again, we'll talk about that in further conversations a little bit later. But let's assume that you don't know where you're starting there, and you just want to improve your chances of success and improve your chances of not losing your bankroll, so to speak. Sorry. Cut losses early, let profits run. Stand to gain, and this is really the crux of this. Stand to gain at least as much as you have to lose. So if you do follow, this general trading style, so the RSI strategy, again, it's very simple. It's a range trading style. You sell something that's expensive, buy something that's cheap. Sounds pretty good. I mean, it can work for a long time, and the stats bear it out. It works more often than it doesn't, at least on a per-trade basis. But when you are wrong, you're going to lose a lot. So cut those losses early, and that's really what it comes down to. At the end of the day, you want to let those profits run. And in this case, again, since we're treating it with a relatively high probability of success trading strategy, trading style, you want to stand to gain at least as much as you stand to lose. So that means a reward to risk ratio of at least 1 to 1. What does that mean in concrete terms? So that means that on each trade, my profit target is at least going to be equal to my stop loss. So the top line here is a 1 to 2 reward to risk ratio, which is pretty close to the average reward to risk ratio for our clients according to those 4 quarters of data. And that's 45 pip profit target, 90 pip stop loss. I mean, again, you're putting yourself behind the 8 ball here because you really stand to do poorly if those losses are much bigger. I'd much rather see you at a place where, like in our optimization, like in that 6-year stretch with the dollar Swiss franc, we're standing to gain 120 pips per gain, we're standing to lose a maximum of 115 pips, which is just about a 1-to-1. And obviously, if you have a lower probability system, but it tends to produce really big winners, you can tweak that around a little bit. You probably want to make it even bigger. You can go to 2-to-1, stand to gain 230 pips for every 115 pips risk, 345 pips, so 115 pips. Really depends on the trading strategy. But what I want to show you is this. So past performance is no guarantee of future results again, but I'm a gearhead. I like looking at what has worked in the past. I like coding things. I like breaking them apart. And what I did here, and let me explain this chart. I know it's noisy, it's confusing, but when you code something and you look at its hypothetical performance, you can tell your system, in this case, the strategy trader platform, I want the top 1,000 combinations of stop losses and profit targets. And that's exactly what I did. I ran 1,000 different tests, which is actually a lot faster than it sounds for something this simple, but I ran 1,000 different tests. I took the top 200. With those 200, I compared the size of the stop loss to the profit target, actually the reverse, so the profit target to the stop loss. That gave me my reward to risk ratio. And the y-axis there is the return on account. In backtesting terms, you have what's called your acquired account size. That's how much you would have had to have started with to actually, been solvent at the end of the strategy. That's your maximum drawdown. So we're comparing the final profits against that maximum drawdown. That's a rough and a good idea for risk-adjusted returns. So on the x-axis, reward to risk ratio. As you go further right, a bigger reward to smaller risk. As you go up and down on the y-axis, you have your return on account, which is again a proxy for what your risk-adjusted returns. A lot of words, but what I really want to point out, you see that dotted line right there? That's approximately the 1-to-1 mark. These are the top 200 tests of that 6-year stretch in the R-size strategy. The best reward to risk ratio, when you try to smooth it out, and that red line is a bit of a moving average, just to get rid of the choppiness, that peak in the moving average is just about the 1-to-1 mark. So again, past performance is no guarantee of future results, but at the same time, 6 years is a lot of time. And if you do follow this general profile, and all of a sudden you see that the best 200 results you could have had, the peak of those results were right around the 1-to-1 mark, you have something there, I think. And you really start to get a sense of how you might stand to gain, how you might stand to improve your chances of success. I briefly alluded to the fact that you can trade with slightly better reward to risk ratios, depending on your trading strategy. I mean, with the RSI, you don't need, given past performance, you typically don't need, and it might actually hurt the strategy to try to, and I'll go back just 1 second. Notice that when you go all the way to the right, the return account, the risk-adjusted returns tend to actually sour a little bit because, again, if you try to understand the RSI strategy, you understand that those winners aren't going to be that big. You risk approximately as much as you gain with this particular trading style. But if you don't fit that mold, and again, I picked the RSI for a reason, if you don't fit that mold and you are more of a momentum trader, so you buy something that's expensive because you think it's going to rise in value further, and that's definitely a viable way to trade, then you might want to trade a little differently. And a perfect example of this is the moving average crossover strategy. I don't have it on a chart here, but who knows what a moving average crossover strategy is? So most of the room does. Just to go over it really quickly, so these are the results of the moving average crossover strategy, the same 2002 to 2010 stretch on the euro-US dollar. And basically what we're doing is we're buying if the 50-period moving average is above the 100, which is above the 200. It's a lot of words. All you have to understand is you're buying something that's rallying, you're selling something that's falling. And let's look at the stats. So 228 total trades, 83 winners, 145 losers. That gives you a percentage profitable of a mere 36%. That's about a third of your trades. But when you look at the average winner, it's 262 pips. Your average loser is about half of that, 137. And at the end of the day, your average win and loss per trade is actually positive because, again, you're using a slightly different trading technique. And in this particular trading style, when you're trying to catch those big trends, when you're right, you're really going to be right. When you're right, you might catch the euro from 130 to 145 or 150. We almost got to 150 just a couple months ago. When you're wrong, you're going to be a little wrong because that moving average is probably going to flip. And when we do that same chart that we did for the RSI strategy, again, I did 1,000 different combinations for profit targets and stop losses, and I sorted those by reward to risk ratios. What I want to point out is that x-axis is much bigger than what we had earlier. It goes from 0 to 10. And these are the top 200 combinations for the euro-US dollar through that stretch. Notice that we don't see any such peak at 1-to-1. And the reasons for which are pretty simple. When you're only making money on 36% of your trades, you probably want to gain a little bit more than you stand to lose. And by a little bit, I probably mean a lot more. So you're seeing that that same optimization is showing you that you probably want to lean towards as much as 5-to-1 or 3-to-1 or something of that nature because, again, it's a low probability strategy. It's all a numbers game. You know, if you make money a third of the time but your winners are way bigger than your losers, you can win. But you have to understand that, and you really have to put that into practice so you really give yourself a winning chance. You don't want to be part of the herd, and the herd, the numbers don't lie. The herd just lets those profits run really long. And you know, if you're in this to make money, and you're not in this to just take frequent profits just to make yourself, you know, a little bit more confident and things like that. And Forex can be a little fun if you just, you know, leverage yourself to the hilt and bet really big and take a lot of winners. But that's not investing. That's gambling. I think you're better off taking all your money and betting it on black at the roulette table. Let's be honest here. So if you really want to make this a business, if you really want to give yourself a shot, and I suspect that especially this gentleman from Australia didn't come all the way here just to play a few games of craps, you know, you really want to give yourself a shot, you need to understand, you know, real important facets of trading and how to use money management to your benefit because, again, those stats don't lie. The crux of it, call losses early, let your profits run, understand the dynamics of your specific trading style. So again, if you can recognize the fact that you like the RSI system, you tend to follow it pretty closely, I'd say stand to gain at least as much as you have to lose. And I personally haven't really found any systems that work well on less than a 1-to-1 risk to reward to risk ratio. So keep that in mind. Reward to risk should rise when you have a lower probability strategy. I mean, that makes sense. If you're only making money a third of the time, you want to make your winners pretty big. And I think that's fairly intuitive. It's intuitive when you look at it on paper, but when you're in front of your trading platform, it's tough. It's just a whole different ball game. When you have actual money on the line, you know, your emotions change. I get very emotional when I'm trading. Sometimes I need to give myself a break and say, all right, you know, I know you're floating a 100 pip gain on this strategy, but you were going for 300 pips. So take it easy, let it ride. If you're wrong, you know, that's your system. You only make money a third of the time. But when you're right, you're going to really be right. So understanding how you trade and how can you can best trade is a huge part of this. So I want to open the floor to questions. Again, I can't thank you enough for making it out here. I can guarantee you we have a lot of great content, not only myself, but my colleagues. We spent months in this stuff. And if you like something, let us know. If you don't like something, definitely let us know. Because, again, this is something that should be happening every year. And next year we can make it even better. So thank you again.